caveat emptor or fill up your boots? Jack Howe gives an appropriately balanced view of that in Smart Money magazine. Jack, Facebook, how can you not be part of Facebook? Aren't you swept up in the frenzy? You give the old, I mean, I'm going to tell people what they're going to read. You gave them the old, listen, maybe worth having, but beware on the first day kind of thing. Is that, am I over-interpreting?
I'm not the stock market's grandmother, okay?
Right.
So I can tell you that it's too expensive, but I can also tell you that scratch-off lottery tickets are a bad deal.
Right.
People are still going to buy them.
Right.
So I wrote about, look, if you are going to...
You don't want to fight. You don't want to fight the crowd. You're,
I can only tell
you're going
people,
along to make nice with people.
You know, people who are going to buy this thing on first day aren't buying it because they love the price to earnings ratio or something like that. They're buying it because they say, hey, I'm on Facebook all day, every day. I think this thing's going to continue to be
to the
here.
moon.
I'm going to buy it. I'm going to make 100 times my money, whatever. So I just presented some of the realities of the situation for people who are going to buy it in open trading on that first day.
Right. Now, one of the questions that I think investors should ask themselves, and I don't know if people ever do, I mean, there's a case, and I think you make it very effectively here, that if you buy a hot IPO on the day, you may get a first day bounce, you may even get a few day bounce, but that history has tended to show that a lot of these that are priced very full and go higher, often within a few weeks or few months kind of peter out. And we saw that, for example, take LinkedIn. LinkedIn closed the first day at like 105. I think it peaked at like 122, and now it's trading around 70 bucks. And it's probably still fully priced at 70 bucks.
Right, LinkedIn, Groupon, Zynga, the class of 2011, they all went lower. Now, absolutely bizarrely, today, those same stocks are up 5% to 15%, somewhere in there.
It's a sympathy
There's
buy.
no new information out there, so lest you think that stock market investors are all rational actors and they only buy or sell based on the facts of the information. There's nothing new about these companies. We've added $2 billion collectively to their stock market value today. So,
well, you know why that. I mean, if you are a hedge fund right now, you play these high beta situations. And there's two ways of looking at a high beta situation. One is there have been investors that have been, I'm talking hedge funds now, but I'm sure day traders and lots of people who like to gamble, have been shorting what available float there's been in the LinkedIns and Groupons and things like that. And then there are the people, the hedge funds, that are going against the tide, are going, you know what, there's going to be so much Facebook frenzy that you could probably safely pile into this thing and get what they call the halo effect around these stocks. And so you have this tug of war between people who've gone short in Zynga that are now covering their shorts, and people that are going long figuring this will last a few months.
Yeah, this is
there's no fundamental valuation going on here,
in the stock market, you've got the Warren Buffett game where you say, I'm buying this because it's cheap and the market will realize its value down the road. And then you've got the musical chairs where you say, I'm buying this because some other sucker is going to pay more for it after me and I'm going to sell it to him or her.
What do you think is going on in Zynga and Groupon and the rest of those today?
I think it's for people who are so excited about Facebook and can't wait, and they want to get involved in something they want to trade today based on the anticipation, the eagerness. I mean, I don't see any fundamental reason that those companies are worth $2 billion more today than they were yesterday. It doesn't make sense.
Is there any reason why a retail investor, should be realistically even thinking of touching a stock like Facebook in the first week or two?
The cons of it, the argument against it is that anytime you have an IPO, it represents very informed investors who are selling their stake to you. And if they're selling, why? And that's why most IPOs underperform. There is one shining example, of course, in Google, which went public 2004, so it's multiplied 5 times in value. Keep in mind, Google went public around when it had a stock market value of $25 billion. With Facebook, they're talking 75 billion to 100 billion. So if you're buying this thinking it's going to be the next Google, please understand that you're getting in.
You're missing the 3 times the money before you get to the 5 times your money.
At a much later stage. You know, the average stock in the U.S. right now is between 1 and 2 times sales. The value of this thing puts it at 20 to 27 times sales. For this to become as big as Google someday, it needs to multiply its earnings tenfold. So, like, I'm not saying that Facebook doesn't have growth ahead of it, but you've got some wild expectations if you think this thing's going to multiply in value.
One final question for you, Jack. Then I got to go. Are you a Facebook user?
I'm not on it. I reserve my name, but I can't get on. I wish I could get excited about that. I just can't bring myself to.
You heard it here. Jack Howe, Smart Money Magazine, not a Facebook user, although apparently he's registered his name. Not yet?
Not yet.
Something tells me it ain't happening, but I could be wrong.